Hi, I'm Faith Schwartz, CoreLogic Senior Vice President of Public Affairs in Washington, D.C. National housing trends are on the rebound, but we see great divergence in the state of Florida. From the macro view of national and state figures, the recovery is well underway in the housing market as the U.S. continues to recover from the nationwide downturn seen in the mid-2000s. Mortgage loans and delinquency continue their downward trends, and negative equity continues to subside as CoreLogic's National Home Price Index, called HPI, posts positive gains with the home price appreciation. Though these positive steps are welcome, the narrative of the localized recovery storyline varies from jurisdictional boundary to boundary. At CoreLogic, we recently took a deeper dive on Florida as one of the states most acutely impacted by the Great Recession, to track activity in key counties in Florida beyond the national and state spotlight. From 2009 to 2013, the state of Florida experienced an average delinquency rate of 16.2%. As one of the state's most severely impacted downturn, the state became the recipient of over $1 billion of hardest-hit fund allocations from the Making Home Affordable TARP funding through the U.S. Treasury Department. These funds were established to localize local support programs administered by local housing finance agencies in distressed markets. The programs assist in stabilizing communities and help to prevent foreclosures through loan workout programs designed by the local communities. As of June 2015, Florida's hardest hit fund had assisted nearly 23,234 homeowners through 6 of their active programs, which include unemployment, mortgage assistance, loan reinstatements, modifications, principal reduction, and elderly mortgage assistance as of April of this year. And they even have a down payment assistance program they introduced. These programs have made an impact, though the criticisms have been made that alleged dollars and programs have not been utilized quite as effectively as intended. Other major recipients, such as California, already allocated over $1 billion to participants in their programs, while Florida has lagged, only exercising half of their programmatic dollars as of mid-2015. From the perspective of home prices, Florida HPI is still 38% below its peak value. Taking a look at CoreLogic's home price index levels for different counties within Florida further highlights discrepancies in recovery at local levels. By looking at the current home prices as a percentage of their peak reading, we find that 50 counties for which CoreLogic generates an HPI, more than half has readings that fall 70% below the peak value. For instance, Miami-Dade County, Walton, and Monroe, all coastal counties registered index values above the national average as of August. But despite that growth, we're still 25 to 30% below the respective peaks during the run-up. Negative equity continues to persist within the states, particularly in the central region, where Polk and Orange County continues to have greater than 20% share of mortgages in negative equity as of mid-2015. The central region and interior counties, which rank the highest when measured by the number of seriously delinquent loans, with Glades and DeSoto counties still in the double digits as of July 2015. Out of all 67 Florida counties, 25 have seriously delinquent rates, twice that of the national rate of 3.51%. Despite these lagging trends within Florida, the state has been leading the pack in a number of cash sales transactions. In early 2011, cash sales transactions peaked at nearly 60% of all sales within Florida, versus the peak of 46% in the national level during the same period. Debates continue over whether these transactions should be viewed as a positive, injecting new capital into neighborhoods and communities, and bottoming out in downturn, or whether the cash transactions might be converted into unkept rental communities with high risk of mass sell-offs during distressed times. Considering the volume of cash purchases in highly urban areas, it will be important to ensure that dense areas of cash transactions continue to recover with the rest of the traditional purchase transactions. States that were significantly impacted from the housing bust often need some localized support coupled with national solutions. The hardest hit funds, mediation, housing counseling, they're all tools that are used to help navigate the loss mitigation of severely delinquent loans. With nearly half of the hardest hit fund dollars still waiting to be utilized by the local program, it will be important that they are exercised efficiently and in a surgical manner, given the differing pockets of distress within a highly diverse state that remains ever important to our economy. As always, thanks for joining our update. For more on CoreLogic's perspective on the U.S. housing economy, please visit the Insights area of CoreLogic.com.